In the last video, we covered off the property market outlook for 2024, so I thought it was only fitting that in this video, we have a look and do a deep dive into the stock market. And that way we've covered off the two major asset classes for investors. But before we jump in, let's do a quick recap of where 2023 left us. Overall, it was a pretty good year for equities. US stocks in particular did very well, with SP 500 finishing up 24% for the year. This was largely driven by tech companies, with about 2/3 of the gains coming from the Magnificent Seven, which include Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. European stocks also did well with a 13% annual gain. Our local market didn't do quite as well, with the ASX 200 finishing up 7.8% for the year. Still not a bad return, and the best annual return the ASX has had since 2021. Much of the rally towards the end of the year was driven by the expectation that the interest rate cycle has peaked. Or in other words, inflation is trending downwards, so investors are speculating that central banks won't really need to hike interest rates any further, and the next move for rates should be down. And this can be seen in the bond market. The bond market is a good indicator of investors' expectations around interest rates, and in turn their expectations around future economic growth and inflation. The Australian 10-year government bond yield fell from a high of around 5% in October 2023 to approximately 3.9% in December. But is the bond market correct? Have interest rates actually peaked? And also, what are some of the fallouts or some of the lagging effects of having gone through such a rapid increase in interest rates? These are some of the questions that we're going to be looking at in today's video as we look forward towards the market outlook for 2024. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we are looking at the 2024 stock market outlook. Now before we jump in, just a quick word of caution, and that is that market predictions are like weather forecasts, in that they are often wrong. You should never base your investment decisions solely on what you expect to happen. Rather, have a set financial plan, know your risk profile, and then you can tweak around that plan based on expectations. The relentless increase in interest rates has seen the official cash rate jump from a low of 0.1% in April 2022 to its current 4.35%. And this has one key agenda, and that is to throw a bucket of cold water over the economy to cool down inflation. And largely, it appears to be working. In Australia, inflation fell from its high of 7.8% in December 2022 to its current 5.4%. Investors largely expect this trend to continue, which would mean that we are at or near the peak of the rate hikes. If interest rates do start to fall, this is going to be positive for equity prices for a number of reasons. Firstly, borrowing becomes less expensive, so businesses have more free cash flow and more likely to leverage in order to expand. Secondly, many stocks are valued based on future discounted cash flows. Low interest rates means higher future discounted valuations. And finally, when interest rates are high, investors are less likely to take risks in order to generate a return. For instance, if you can generate a relatively safe 5% on bonds, why risk volatility of equities? Given that interest rates are largely expected to fall next year, this is positive for equity prices. But there's a catch. Stock markets are always forward-looking, which basically means that if there is an expectation in the pipeline, this gets factored into the equity prices now. The rally in stocks that we saw at the end of 2023 is already factoring in the expectations that we are at the peak of the interest rate cycle and that the next move is going to be down. Now, if that expectation doesn't come into play, so if interest rates stay higher for longer, or worse yet, if interest rates were to increase again from here, well, that could potentially be very negative for equity prices. When interest rates increase, you don't get the full impact of that increase straight away. It's a little bit like getting bitten by a mosquito. So when you first get bitten, you get that little pinch, which is the equivalent of, say, your variable rate increasing. But then later down the track, you also get that red itchy lump that you just can't help scratching. And so in economics, that is known as monetary policy lag. The three key lags at the moment are fixed rate mortgages, savings rates, and consumer sentiment. The peak of the fixed rate mortgage roll-off passed in June and September quarters of 2023. However, there are still a few floating around. Most of the remaining cheap rate fixed loans will expire over the next 12 months. Savings ratios have dropped considerably, with the level of disposable income dropping, and consumer sentiment is still well below its long-term average, which means expenditure is likely to be subdued. All of these indicators suggest that economic growth is likely to continue to slow, and that's largely expected. But the real question is, how much is it going to slow by? Will we get a soft landing scenario where things cool off just enough to bring down inflation without meaningfully impacting economic growth? Or is economic growth about to plummet, pushing us into a recession, which is going to lead to higher unemployment, job losses, and yes, of course, a negative impact for equity prices? At the moment, we don't really know which way we're headed, so only time's going to tell. One indicator that suggests a recession is on the cards is an inverted yield curve. Now, what this basically means is that short-term government bonds are giving you a higher rate than long-term government bonds, which means that investors aren't getting that risk premium for putting their money away for longer durations. This suggests that something is askew in the economy. In the US, an inverted yield curve has predicted every recession bar one since 1955. The time between inversion and when the recession hits can vary substantially, historically being anywhere between 6 and 22 months. Currently, 31 countries across the world have an inverted yield curve, with Australia currently sitting on a partially inverted curve. I'm always very hesitant to predict where the price of any asset is going to go in the future, because there's always a huge number of variables that are constantly in flux to make any prediction have any merit. Every time you come across a piece of information, you'll come across another piece of information which says the exact opposite thing. So for example, take interest rates at the moment. Commonwealth Bank is predicting interest rates to drop by 0.75% in 2024, and the Australian Financial Review is adamant that rates won't be budging this year. However, if I had to choose a path, I would say that heading into 2024, I am proceeding with caution. Valuations of stocks on traditional metrics are quite high, and the alternative, with sitting in the sideline on defensive assets with things like bonds, is quite attractive. However, I never go all in or all out of equities. All I do is tweak portfolios. The key driver of your portfolio's performance in any market is always going to be driven by your asset allocation. Now, that is your split between growth assets and defensive assets. And your asset allocation is going to be dictated by two key drivers: your comfort with volatility and also your investment time frame. And we use a risk profiling process to help determine an appropriate asset allocation. In my portfolio, I let the risk profile dictate the portfolio position. Then, within each individual risk profile, we make tilts depending on where we see the outlook headed. So for instance, if we think equity valuations are high, we might tilt a little bit more defensively in portfolios. If we think equity valuations are low, we might tilt a little bit more towards growth asset in portfolios. However, it's important to note that the tilt is never more than 10% from where we want to be over the long term based on that risk profile. Under this strategy, you're bringing a lot more discipline to your investment approach, and you avoid a lot of the noise that comes with the stock market. You get your plan set up front, and you keep on investing in accordance with that plan despite what is happening. Now, there are a lot of other factors that we could have considered in this video, such as the US election, geopolitical tensions, the slowdown of the Chinese economy. But to be honest, a lot of the things that impact stock markets the most are the things that we don't expect or don't see coming. So fingers crossed we don't have any of those in 2024. But that's it for me today, guys. Thanks a lot for watching. If you found this video useful or helpful or interesting, please give it a thumbs up, and I will see you guys in the next one.